So, and we're getting some stuff going on. I'm gonna go through some housekeeping, and Chris is asking Mike, is that a Commodore VIC-20? Ironically, we're just talking about the Commodore 64 and its predecessor. So, Mike, it's all about the Q&A. I'll let you jump in while we're waiting for the rest of the people to hop in, and we'll get started here in a few minutes.
That is an Atari 800 with glorious 48K of RAM, and it is working.
His first computer at Georgia Tech. Go Jackets. I think I'm the only tech grad here, right? Love
Go
it. You had
Dogs.
it.
Does it
Yeah.
does it count that I have two coming, one that's just finished and
Yes, it
halfway
does.
through?
Yes,
All right.
we're letting you into the club.
Okay,
Go
well,
Jackets.
thanks.
Yeah. So class of 97, Chris Carter. Um, so before we get started, everybody, and I'm sure I'll be saying this multiple times, please keep the questions. We're gonna batch them at the end. Everybody's gonna get a recording after. Please put the questions in the Q&A, not in chat. Um, and as kind of a framework today, this is kind of fun because literally this is the nature of my business. It's like hanging out with three other friends that are all experienced in what they do, and we're just talking shop about how business exits actually work behind the scenes. And I want you to think of it as, hey, you're getting visibility to a small group of professionals that happen to be friends with different lenses: legal, business valuation, M&A, and wealth strategy. And so we're all just kind of comparing notes. And so you don't have to make the same mistakes that others do. And so again, housekeeping, please keep the questions in the Q&A, not the chat. And with that, I'm going to do some intros, and there's the chat. Okay, great. Okay. So here is the team. You're looking at them that you're going to want in your real exit. And first, we had to do a switcheroo on you. We had Mitesh Patel coming in, and unfortunately, he had a nasty accident on the Silver Comet. So for those of you that know Mitesh, I would reach out to him. We've seen the pictures. And Nathan Johns, thankfully, thank you, Nathan, popped in on his behalf. And he is our business attorney who helps keep deals clean and protects owners. Welcome, Nathan.
Thanks for having me. I'm happy to sub in, and I will do my best.
Yeah, absolutely. Can you kind of give us a quick update on Mitesh for those that know him?
He is looks bad, but sounds much better. I think he was going to join on just to hang out and watch the panel discussion, but he is pretty banged up and looks really bad. But he said he will not be coming into the office this week, probably next week.
Got it. So the next person on your team that you want in your real exit as you're building your business for value is going to
There he
be.
is.
Wow.
Now he's gone.
Okay. He did hop in. Okay. Well, we'll let you guys
Yeah, I don't know that y'all want to see me.
I
got
saw
it.
you for a second.
You get a
There
little
we go.
preview.
Yeah.
That is motivation, folks.
Lordy.
Yeah, man.
Okay.
And
That's
oddly
all
enough,
what you can
see.
it fits
What's
right
that?
into our discussion because accidents happen, and sometimes you need to be prepared for an unexpected exit.
Oh
Yeah.
my gosh. Well, this was, yeah.
So,
For sure.
so next I want to introduce Mike Blake. Mike, we've known each other, what, 15 years, maybe 20?
Little over 15.
Okay, yeah. Business Chronicle, 40 under 40, same class. Mike is a valuation expert who helps owners understand what their business is really worth and why. Welcome, Mike. Didn't know if you have anything else you want to add on what you do and why.
No, just telling everybody hello from beautiful Lisbon, Portugal.
Yay. And Mike knows how to work in multiple countries. He did his own sort of personal exit overseas after being Atlanta based for a long time. And next, my friend Carl Nickpon. Carl is the M&A advisor who builds curated buyer processes and really helps use competitive markets to drive top dollar exits. Welcome, Carl. Don't know if you have anything else you want to add real quick.
Great to be here, and I'm looking forward to the conversation. So ready to jump in.
Yeah, absolutely. And I'm Meredith Moore. I'm a certified exit planning advisor, and I've been a financial advisor for 26 years. My job is to quarterback your entire team and help you align business value with your personal wealth plan. And so you can exit on your own terms. And so, again, to reiterate, this is just a conversation among friends today that we all have different expertise. And one thing I think a lot of people believe is they are owning businesses, they're grinding every day, and they don't have a lot of time to meet with professionals and don't want to pay for it. But business exit isn't a one-time thing in that how can you always be thinking about driving business value? Whether you choose to exit that year or not, it doesn't matter. But how do we consistently work on growing the value of our company? And in using everybody here, I think you're going to get different perspectives on how to think about it. So again, housekeeping, please put your questions in the Q&A, not in the chat. And I'm going to get us kicked off with our first question. And so here we go. We're going to really jump into what are some of the biggest mistakes before a sale. And this is where I see owners lose seven figures even before they realize the business is at risk. So let's start here in that most business owners don't know the number that actually matters. Mike, let's start with you. Maybe from the valuation side, and then Carl and Nathan and Mitesh again in the hospital bed or your home bed, jump in if you see something different. Um, Legal gaps. Nate, Mitesh.
So many gaps. And as you're saying, the price is the most important thing in the deal, but the documents, the definitions in those documents, how those documents are set up, that is going to drive a lot of discounts if they're wrong. So things we see that is a huge mistake before the sale, not getting your operating agreements in order, not getting your cap table together. We've got folks who come to I had a deal, $20 million sale, 3 owners, and about a week before closing, they remembered, oh, we have all these profit participation people. We have these 7 other guys who we brought in at the beginning, and they've been hanging around. And now we've got to figure out, okay, where are they? Who are they? How much do they own? You've got, phantom equity, you've got options, safes, all sorts of missing things that it happened 10 years ago and I forgot. So that's a big one, knowing who actually is the owner. Unassigned IP, you had a contractor work on something, you didn't get a proper assignment. You've got bad documentation on your employees and contractors, especially if you're in certain industries that have a lot of compliance I-9 issues. So there's just a host of contracts that are out there that you're not paying attention to, and getting all those cleaned up beforehand, super high value for very low cost. It just makes life easier going into a transaction.
And it seems like a lot of what I see is a lot of owners have not looked at the operating agreement in years. It's almost like having estate planning documents or wills or trusts. It's a checking the box and put it away, and maybe I'll look at it in 15 years.
And if you got good business partners, that's fine, because you don't need it until you need it to say, I want to force this to happen.
Right.
But again, definitely, as the business has changed, as tax laws have updated, that's a big thing to nail down. Especially another mistake: are you an S corp or not an S corp? People make the election. People think they make the election. People can't find their election, so it's one of those very important to the deal, to the pricing, to the tax attributes of a transaction. Just knowing how your structure is really set up from a tax perspective.
So Mike, what's the number one mistake you see owners make before selling?
Boy, there's so many, but how do you choose between, what's your favorite child, right? I think the biggest mistake I see is failing to look at the business through the objective lens of a rational buyer that has no interest in making you happy, right? So, and Carl's probably seen this dozens of times too. You get business owners that imagine a value of the business because that's the value that they just sort of need in order to retire, or they feel like they want to be paid for sweat equity. And I have yet to see anybody buy anything with sweat equity yet. Maybe somebody else has seen it. Um, or, the business isn't very successful, but there's this narrative that, well, with somebody who is smarter with more energy could make the business profitable, right? Well, why would I want to do that? So it all rolls up into failing to look at the business with a sense of true objectivity and understand the perspective of a buyer, that a buyer doesn't want to buy a mess. A buyer doesn't want to buy a reclamation reconstruction project. Or if they do, they want to be compensated handsomely with a massive discount. They want to buy something they can step into and is going to generate cash return right away without skipping a beat.
And I would say the story of the business is important, and I think that's where Carl comes in. But the evidence of why it's a story that makes sense and makes economic sense, that's where Mike comes in.
Yeah, Carl, what's your take? What's kind of the biggest mistake you see owners make before selling?
Well, I think, when we look at some of the reasons why businesses don't have a smooth transition, that maybe points to some of the mistakes about preparing for one. And one of the biggest is dependence on the owner. And, they've got to have it all in control. They've got to, they make the sales, they make sure delivery is happening. They've got it all. And it's not just that we want to see the owner literally fire him or herself from those roles, and really truly be the chair of the board. That's the ideal situation, right? That means empowering the leadership team to make decisions, not just be the ones to execute, but really make decisions and not have to come to the CEO every time there's a question, right? Being able to do it on their own and empowered is critical. The other thing that I see a lot of is some pretty messy financials. There are two reasons that we could have unclean financials. The first is simply because they're poorly kept, and we don't have a professional accountant in the role of being responsible for the financials. Sometimes, the owner thinks, I have all these tools at my disposal. I'll just do it because, it's not that hard. Unfortunately, it's very easy to mess up. And that's one reason it can be unclean. But the other reason it can be unclean is because the owner is mixing personal expenses with the business. And when we have a business that is really clean and clear, that's what gives confidence to a buyer that the cash flow that it appears to be generating is what it is actually generating.
I like to say that there's the real number and then there's the tax number. Many of us here all own businesses and we run certain things through, and the technical term is recasting EBITDA. It does not include your country club membership. It does not include your gym membership. So is the business still going to employ your kid? I get it. We all have our tax number, but I'm going to encourage everybody here, know your real number, not just the number that you report to the IRS.
And I think one of the things that is missing there is such an opportunity if you hire, whether it's a full-time or a fractional CFO, someone who is really good at understanding what the numbers are saying about the performance of the business, and someone you give permission to challenge you. Not just be a yes person that like, oh, that's what you want to hear. No, someone who's going to look at you and say, this is what the numbers are saying right now. I'm not sure that we should rest on that comfortably. But if we tie all that together, and if I said there was one thing that pulls it all together, I'd say it's that owners trying to do everything on their own. Thinking to themselves, I know the buyers, I know what I have to do, I know my industry better than anybody, and all of that might be true, but I think it makes a real big difference when you hire experts in the various domains and let them really help you make a difference in your business.
But
And
also
Paul,
making sure that they're talking and coordinating. Go ahead, sorry.
right. People who are trying to do it themselves forget they still have to run a business. So even if you could do it all yourself, you don't have the time.
Yep. Yep. Amy had a quick question. Do most acquirers want a C corp, not an S corp? Who wants to jump in on that one?
From a legal side, I would say it depends on if they can even be an S corp. I've done so many F reorgs in the last couple of years. I would say S corps are not what people are looking to buy, especially if it's an asset transaction. A C corp, depending on what, maybe there's some regulatory issues that make sense, or there's a cross border transaction. But most folks I see are not looking for an S corp transaction.
Yep. So the biggest mistake that I see is entrepreneurs are running their business, and wealth is built very differently than it is with somebody that is a senior leader in corporate America. They don't have company stock at the Fortune company and all this stuff. And so they haven't hired an advisor because the advisor a lot of times won't work with them because their money's tied up in privately held stock as well as real estate. And so they don't know what their number is. Like if I needed to exit this business, how much do I need? And you may hear the term by other exit advisors, wealth gap. It is simply what is your wealth goal minus what you have. So if I figure out that Mike Blake lives on 300 grand a year with that business, we've recasted EBITDA, it's his country club membership, it's everything. Sorry, Mike, I know that's not your jam, but I get to pick on you. I got to figure out what bucket of money do I need to get from this business if we're exiting. So it's the financials, and then part two, it's the identity. Like, who are you after you sell this business emotionally? We see everybody here, all of us see the psychology of that. That person's identity for 20, 30, 40 years is tied to this business. And so what's next? How do I need to be thinking about my next chapter?
So Meredith, I'm glad you brought that up because actually one of the first questions I ask a client or even a prospect when they tell me about selling a business, I ask them, who's your wealth advisor? Because we need to figure out what your number needs to be. Now, this sounds like I'm talking out of both sides of my mouth with respect to what I just said 3 minutes ago, but it's not. It's a puzzle piece. Just you may find out that you need $3 million to retire. That doesn't necessarily mean your business will attract that, but we need to know what the bogey is, and then that's going to tell us what the time frame may be to then achieve that. And if I could expand on that a second, Meredith, because knowing, I've been thinking about this recently, and there's actually two numbers you need to know. There's the value of the business, but also there's the return on the business. And something a lot of people kind of forget is that if you're operating a business and not something that's masquerading as a high stress, high risk job, then your business needs to be generating a return on equity. And you don't have to be rich like Warren Buffett to think like Warren Buffett. And if you want your business to have value, you need to start thinking in terms of what return is this business generating? And you need that return needs to be put in the context of the value of the business so that you understand what the return on equity is.
No, I think we lost
Nathan,
her.
you're the host now.
I'm the host now.
Congratulations.
Yeah, I got promoted real fast. Well, we'll wait for her to join back in. That was an unexpected one. So
that wasn't, but I think Nathan, we should kind of just keep the conversation going a little bit because
absolutely
take her a moment. And I think one of the things that would be useful for us to consider is, well, what does readiness really look like? And so when you're thinking about it, Nathan, we'll start with you on the legal side. What does that look like?
So again, readiness really comes down to a lot of the things we've already talked about. Do you know your number? Do you know the value of your business? Do you have all of the information at your fingertips so that you can provide it to the advisors? Do you have your contracts? If you're a heavily driven contract business, have you looked at those? Can you sell those? Are those assignable? Are there any regulatory issues that you've got to go and get somebody's consent? Your top 20 vendors, all of those things are going to be on the diligence list the buyer's asking for. So do you have it? I can't tell you how many times we've sat down with somebody and said, this is what they're going to ask. Give us this information. They're like, well, it's going to be 2 weeks before we can go find all that stuff. We haven't looked at it. So just actually having that information around is a huge readiness signal. Are you in compliance with everything you're supposed to be in compliance with? It's surprisingly, a lot of folks are not. And they find out when a buyer comes in and kicks the tires, you've got a lot of problems. And we want to do all of that sort of like a pre-transaction diligence, a pre-Q of E, so that you get rid of all the bad stuff before the buyer finds it. Because as soon as they see an issue, purchase price discount. As soon as they see something that's a question, we want to pay less. So if you can chop all those things down and go to market with something that is relatively clean and streamlined, you're going to protect that purchase price and you're going to be ready to sell and close a deal quickly, because time kills deals. The longer it takes, the longer it drags out. It is the death knell of transactions.
Yeah, I think another way to say that is deals age like milk, not wine.
Exactly.
Uh,
I'm stealing that one.
Mike, how do you spot when someone's not financially ready?
Well, I can spot when somebody's not financially ready, depending on kind of the timeline that they think they want to do a deal in. When somebody tells me that they feel like they need to sell their business like in the next month or two, that tells me they're not financially ready. And the second sign that tells me they're not financially ready is if they don't have command of their own numbers. If they don't have command over what that exit number needs to be in order to meet their financial objective, whatever that is. And if they don't have command of the basic financial operations of the business, then that tells me they're not ready too, because how can you possibly negotiate the sale of something that you yourself don't understand well?
Clearly, yeah. Yeah. And I think, to kind of tie some of those together, I think a little bit about how does a buyer look at this? What's their perspective? And, when the seller has everything all ready together in a neat package, that is something that gives buyers a lot of confidence. They're constantly getting approached. I mean, professional buyers get 1,000 of these opportunities and come in front of them a year or more. And so, if it's hard for them to digest the materials at the outset, they take that as an omen that this is not going to be easy to do. And they don't want to waste a lot of energy on understanding, is this a good deal or not? So if we make them work hard, their answer is, forget this, I got plenty of other options. And I think the other thing too is that when Nathan, you're talking about that pre-diligence, when we have our sort of stuff together, it allows us to have fast response time, and that's what keeps things moving. Momentum is such a critical part of it.
And it's, as a business owner, I get it. It's hard to run your business. It's hard to answer all these questions. It's hard to get all this stuff together. But if you put the work in on the front end, it makes the transaction go a lot easier.
Yeah.
And I also get, we cost money, and it costs money to prepare for this. And you've got to be ready to pay some professional fees if you want to maximize your purchase price. And I have seen folks lose a lot of purchase price by not being prepared. And I've seen people who have paid professional fees in the beginning make 10 times that money back based on the work we did to get there. I think, self-servingly, but yeah, the return on our investment on the money you spend on us, it's well worth it.
Yeah, absolutely. And I think one other thing that, while we can focus on the readiness of the business and the readiness of the financials and the readiness of the personal financials, the other side of that is the mental and emotional readiness of the owner themselves. Are they ready to detach themselves from the business, this baby that they grew up? So anybody want to, share any insights on what that looks like, or how to start to, let go as you're preparing for a transaction? Some of the things that you've
Get a
seen
good
work.
therapist.
Yeah, it's an
Absolutely.
emotional journey. Like really, I mean, literally there are people in all of our spaces that help people with this, like more coming up with what's that next chapter? What are you going to be doing? Are you going to be sitting on boards? Do you want to start other businesses just because it's become so entrenched? Apologize too, I'm having power issues in my new house, so gotta love it.
But
Glad you're
I'd say almost every deal has an inflection point where that seller is up late at night, freaking out about what have I done? How did I get? I'm not ready to let go. I'm not going to sell. And that's when it's important to reach out to your advisors and talk about, again, are you really ready to do this? Is this the right thing? Do you have something to do after this? Because it is a huge life shift and very, very hard to do. If this is something you've been doing for 20, 30 years, and tomorrow you're going to wake up and not do it, and you're not mentally ready for that, it's mind-blowing. So
Yeah, there's definitely a difference between selling your business and actually being ready to exit. Mike, how do you spot when somebody's not financially ready yet?
Well, we actually kind of already talked about that, so I don't want
we
to
kept
be too
going.
repetitive.
Yeah, thank you
Um,
guys. Appreciate you.
Yeah.
Um,
I mean, I
listen,
think
also, yeah, the owner on my side, if they don't know their walkaway number or can't answer it, they're not ready where I sit. And that's minus taxes and fees because the M&A advisor, everybody's gonna get, you're gonna need a whole host. It's not an inexpensive
People
proposition
forget
as you
about the
do things.
taxes. And that's again where the advisors are important because they can give you that
Mhm.
after tax, after expense number. Um,
Mhm.
I actually had a deal die because they ended up never considering the tax bill. And then when they ran it, they're like, it's not enough. We're not going to have enough money. We need to go back and retool the business, spend a couple more years growing it, making best in class decisions. And then we're going to
Yeah.
come back and try again because this is not going to make it. We're not going to make it to where we need to be. I was kind of wish they had figured that out earlier, but here we are. And now they're another year into it and the business is growing. And I think they're going to try and take it back in another year or so.
So we're 3 to 5 years out. What should we do now? Like, too many owners wait until they're burned out before they start exit planning. Would like to hear everybody's take. What should they focus on now to be ready later? Let's start, Nate, with you. Legal cleanup and structure. What are your
Yeah.
thoughts?
So again, employment contracts, NDAs, key people, you want to get all those sort of non-solicit agreements in place. You want to make sure all your contracts that you have are valid, enforceable, have favorable assignment language. You're going to want to make sure your entity charts are up to date. If you are there's a neat little tax trick out there called the qualified small business stock. So if you are a C corp, that's a tremendous thing. I've been waiting for a deal to happen with that. I can't ever get anyone to check all the boxes, but you get a $10 million, capital gain, free money kind of thing. So bother your tax people about that one. Um, and in today's world, we've got so much compliance. We've got uh, data compliance. We've got SOC 2 stuff. We've got all these things. Get that, get it in a binder, keep it updated. If you've got litigation, track that. You've got insurance claims, track that. Just basically be data room ready. That'll help as you're doing it, keep things fresh and give you a nice, easy on ramp to a deal. So 3 to 5 years, getting in the habit of doing that, that's important. And just, building out your management team for for you to actually be able to step away. Because if it's all based on you, the sole owner, That's a very hard thing to sell. Nobody wants to buy that.
Yep. And Carl, you had touched on financial reporting and systems. Curious if you want to give a quick summary there, and Mike, if you want to jump in there too.
Yeah, I mean, so I think we talked a little bit about the importance of having clean financials and systems that run your financials, right? Not things in Excel or worse on the old ledger paper. And yes, we have actually seen those. But I think it's going beyond that, especially the last 3 to 5 years. Again, buyers are looking for, yes, a story, but the historicals to prove that the story is possible. And so what are they looking for? They're looking for growing sales. They're looking for growing profits, and they're looking for a steady growth that is manageable over time, not jagged margins that are unpredictable. That spells risk, and risk is something that buyers like to avoid. Then we can take all that together and formulate a really great story about the future that can get buyers excited. So I'd say on the strategy side of preparing the company itself, that's sort of one thought. And the other thought that I have is as you're looking at 3 to 5 years out, start building the team of advisors around you now. Those relationships, you don't, just trust a lawyer to take you through this transaction, off of a first phone call. This is somebody that you want to know has your back. That's true for all the advisors around the deal. So start building those relationships now. That will be key to creating momentum when the deal happens, because what it removes is the questions that you are asking your advisors, which are really a sense of you being a little bit unsure if you and your advisors are on the same page. If you've already gotten that worked out, you can speed up the deal when it comes time to work with a buyer. Mike, what do you think?
Don't keep those people isolated. Let the team
It's all
talk.
about coordination. All of us can't do what we do without each other.
Yeah, sorry, Mike, I jumped in there.
Quite all right. I used to drive in Atlanta. I'm used to being cut off. So I 3 to 5 years out, I tell my clients, start putting in place a dream team management team that the next owner is going to want to have. And that may mean that the people you have today that are making the business kind of do its thing, they may not be the people that take over the business. And you may have to start having some hard conversations, taking some hard decisions. And as you put that team in place, make sure that your employment agreements have some provision for a retention or a stay bonus after a change of control. You guys have probably seen this where people don't think about these retention bonuses or stay bonuses, but once that CFO or COO realizes that the business can't be sold until they agree to stay on, all of a sudden that stay bonus that could have been $50,000 when they signed up 3 years ago, all of a sudden that becomes $250,000 or $500,000. So don't wait for that. Work with somebody like Nathan and Mitesh to put that in the employment agreement, and that's gonna generate a high ROI on the fees involved to put that contract in place.
Yeah, and in that same vein, with talent and trying to retain talent, a lot of times too, I mean, we're looking at putting in non-qualified deferred compensation agreements and things that we can do to retain talent. The other thing people miss, I see a lot, is they don't have key person life insurance contracts. And we had a client, an owner that had passed away. He didn't have that, and he was personally guaranteeing all the debt. Well, the bank was going to call the note because nobody else could personally guarantee it. The business couldn't get it. And so if you haven't structured, I mean, we'll talk personal life insurance, but the key person is also critical for your people that are critical to your business. If they got hit by the proverbial bus yesterday, what is the impact to the daily operations of the business?
Meredith, I'm sad you didn't say if they fell off the bike on the Silver Comet.
Yeah, there's that.
That was an
Yeah.
opportunity there.
Yeah. Poor Mitesh, but he's here. And then the other thing is back to, I discussed it before, is the wealth gap. The wealth gap is your wealth goal, and figuring out what that needs to be minus what your balance sheet already has. And spoiler alert, it's probably much bigger than what you may think. And so again, I'll say it again, most entrepreneurs don't have a financial advisor to determine what that number needs to be. I would highly encourage you that you figure it out. And then by the time you figure that number out, what Nate and I were talking about before is now we take off the taxes and the fees to get us there. And we did have a question around that too. What is the range? And this is a good one for you, Carl. So what is the range of the ratio upfront cost to percent on deal for an M&A advisor?
That's a great question, and organizations do it very differently. So you might see some high upfront costs. We personally believe that a good advisor aligns his or her success with yours at the end of a transaction. So the vast majority of it really should be on the back end when you get paid.
No, that's great. Thank you on that. And I'll let Hitesh, if he has any other questions on that, jump in. I know he was raising his hand, but feel free to just put it in the Q&A if we could. I've also put in the chat, we're going to obviously keep going, but has everybody's information if you want to talk to somebody later. Here's a follow-up question from Hitesh. How many years of EBITDA constitutes a reliable return that a buyer will generally believe? Anybody jump in on this?
But I can jump in and say that, buyers are intently interested in the last 3 years, and they'll, oftentimes ask for the last 5 if there's something hairy in the last 3. That's what we've seen. Mike, how
That's
about
what
you?
I've seen.
Yeah, I was going to say 3 also, but I think
Yep.
I would only add to that the past is only an indicator of future success if the future conditions look like the past conditions, right? So all good valuation is forward-looking in nature. It's why I have a crystal ball on my desk to remind me of that. And in some cases, in some cases, 1 year of EBITDA may be enough, depending on the rest of the facts and circumstances that might indicate that EBITDA is sustainable. But in the absence of anything, I agree with 3 years for sure.
Yep. Yep. Same.
Meredith, while we're talking about this, there was another question about IP and how that plays into the valuation and expectations. Do you think we could just
Yeah, let's jump in. Go ahead.
Yeah, Mike, what are your thoughts about how IP, if that's if they think of themselves as that's the major part of the value of the business, what do you have to say about that?
So I'm asked quite frequently actually, to do valuations of IP because the owner thinks that the value of the business is equal to the value of the intellectual property. And I routinely talk them out of, or at least try to talk them out of hiring me to do that because I don't think it will help them. Intellectual property as a standalone asset is an order of magnitude more difficult to sell, in my experience, than an operating company. It's much more difficult to do the due diligence. It's much more difficult to make the strategic case. It's much more difficult to price, frankly, as opposed to an operating company that, even if the operating company happens to be significantly dependent upon the intellectual property, 99 times out of 100 or more, I'm telling clients and prospects, sell the company that's wrapped around the IP. Don't try to sell the IP as a distinct asset. You're trying to outsmart yourself and outsmart the market, and it doesn't work.
Yeah, I mean, the IP is itself an asset that generates cash if you put it to work, just like a machine or a fleet, right? Whatever it is that your business used to generate cash, at the end of the day, what we're looking at is the EBITDA, right? So what earnings can this bring in?
That's great. So let me tell you how deals really die. And no, it's not what you think. So we've all seen deals fall apart. We've talked a little bit about that, but what causes that and how do you prevent it? So Nate, do you want to jump in? I have a feeling you might have something to say on surprise liabilities.
Yeah, deals die in a variety of creative ways. I have seen an accountant who found a single line in an operating agreement that blew their S election because it had distributions not based on capital, or based on capital accounts instead of ownership, and it killed the deal. So any sort of surprise, whether it's unpaid taxes, misclassified employees, breaches of contract, things that just come up that are bad news, those will kill deals real fast. Another thing I've seen is again, back to the working capital and what's the real number. Different ways to define working capital. And the number of people who don't understand working capital, I'd say 90% of the people out there don't get it. And sometimes deals do the traditional accounting. Sometimes it's like we're going to tweak here and push there and move this around. And as long as you can reach a documented set of this is the procedure and process to get to this number, fine. But if you don't agree to that and it's not crystal clear, that blows deals up all the time. And just being slow. Again, speed is the name of the game. Gotta keep it fast.
Mike, I bet you see some unrealistic expectations too.
Well, I mean, that my job description is to try to make those expectations realistic, right? So you do certainly see unrealistic expectations, and not only on the price, by the way, but a friend and mentor of mine years ago once told me, I'll give you any price you want as long as you let me dictate the terms. And I've never forgotten that, obviously, because I'm saying it now. But I use that as a framework to advise really anybody who'll listen that price and terms are dancing partners. And if you think of them that way, where they have this sort of give and take along the ballroom floor, you may be able to get that price you want as long as you're flexible on the terms. Or if the terms are really important to you, then you may have to be flexible on the price. So the unrealistic expectations also don't always arise from a price, but also this expectation that every deal happens where at the day of closing, somebody walks into a room with a briefcase full of $100 bills, shoves it across the table, and you just walk out of the building with that. And that just isn't how deals happen, when they're not on TV on an episode of Mad Men.
And even if they do shove a briefcase full of cash at you, they're holding back a good bit of that in an earnout or some other escrow or indemnity, and you're not getting the whole purchase price at closing. So again, the terms on how does that get released, when does that get released, what has to happen for that, those are all factors that could kill a deal or not. And restrictive covenants on what are you doing after a transaction. I've seen guys say, well, as soon as I'm done selling this thing, I'm going to go and open a competing business. Everybody's like, no, you can't do that. And he's like, well, then I don't want to sell then. I'm like, yeah, no one wants to buy it either. So all those things can kill deals.
I'll add,
Yeah, go ahead. Sorry.
I'll add in one more, and it's a function of the owner getting tied up and caught up in the deal and forgetting that his or her main job is to drive performance. And if performance slips because the owner takes his or her foot off the gas, then that gives the buyers, they get halfway their due diligence and they're like, I don't know, it's not looking like what we thought originally. And then they never tell you that your baby's ugly, that they don't want to do the deal. They just say, you know what? Some things have changed for us internally. We no longer have the resources to do this deal. We need to put this on pause right now. That's kind of it's kind of like dies on the vine.
Got it. No, that's really good advice. The thing that I typically see is, I mean, Nate kind of hit on it, is misaligned net proceeds. Like we figure out the wealth gap. Like, what's that number for them to walk away from the business and replaces all the income from the business, but they didn't realize the tax implication and then the fees between the team to get them to that number. And so it's back to the example Nate said, like they're like, well, I don't want to sell them. And so Mike, I think I'm going to use your analogy around price and the terms moving forward. So that's what I
It's open
see.
source.
Yeah, yeah, absolutely. And Carl, I think you hit on some things. Or do you see a lot of misdiligence or like team gaps typically?
Yeah, so I think we've talked a lot about the team already, and so but one other thing that I think is a hot button for a lot of buyers in their due diligence is around employment policies, that they are well documented and that they're consistently applied. And you never know what is a hot button issue for a buyer, based on who makes up their board and the things that they bring to concerns about every deal. But you can count on one of the things that they're going to look at pretty closely is your employment practices.
A lot of
Yeah,
liability, a lot of risk.
we had a all of us on here have a friend that's a trust and estate attorney and was involved on a case, and it turned out that one of the senior leaders, when they were reviewing all the not IP but IT and computers, he had kitty porn all over his computer. Deal obviously was off because now we're dealing with a major issue that involved massive law enforcement and the whole bit. So it's that team is critical in how you're managing for that. It's terrible.
That's
Um,
still a deal.
yeah, yeah. So let's kind of talk about valuation multiples. I think that all of us probably, Mike more than anybody, like my buddy's in the same industry down the street, and he said he can get 3 times profit or 3 times revenue, whatever. Buyers don't pay top dollar for potential. They pay for proof, which we've all talked about. Carl, how much valuation is driven by buyer type that you see? And then what can owners actually do to get a high end of that multiple range? And then Mike, I know it's going to go straight to you next.
Yeah. So I would say, first of all, that everybody always used to think that strategic buyers where it's at because they'll pay the most. Well, the reality is that at this point, there's so much cash sitting on the sidelines with private equity and family offices that they can be very competitive when they're looking at a deal. But more importantly, the price has got to be kept in the context of the overall exit and your engagement and involvement. If are you going to be walking away relatively quickly, or are you rolling equity and wanting to stay on? There's many more factors that I think go into selecting the right buyer than their approach to pricing alone. I think the bottom line is that when you go through a good process where we don't put a price tag on the business, but let the market have the information and sort of fight over your business, then we're going to find out what the opportunity is, and go after all the potential buyers who could be a good fit. So I think the more important question is, how does the financial part fit into the picture of your post ownership life? And then I think the short answer, and this really tees it up over to Mike, is that if you use a valuation to help you identify what are the areas of your business that are depressing the value right now, and then you use that information to hire great experts and advisors to help you impact those quickly, I think that's one of the best uses that you can use of that kind of effort. Mike, what are your thoughts?
Yeah, thanks for that. I tell my clients that if they don't learn something about their business they didn't already know when they started working with me, I don't consider that relationship to be entirely successful. We're going to find opportunities for them to make that business more valuable, whether it's operationally, whether it's de-risking the business, growth opportunities, and then frankly, we hope make that business an easier sell for you out in the market, Carl. So, um, you know, I would like to come back to the statement, buyers don't pay top dollar for potential, they pay for proof. I think that's mostly right. I do think a strategic buyer will pay for potential, but if you want that strategic value, then you really have to empathize with the buyer. You really have to understand why would they see the potential, and be super detailed about how they would convert that potential into something tangible. That is a lot harder to do than it sounds. But it is there. We know that there are strategically driven acquisitions there all the time. But from a baseline, I absolutely agree with the statement that assume that a buyer is going to pay for proof first, and then the potential is something that you might try to build on top of that.
No, that's great. We've talked a little bit about attractiveness and readiness. We've talked about strategic buyers versus financial buyers. The personal planning, the financial planning can also impact the deal structure. Back to, I mean, you can get all the money in the world, but if you got to stay there another 10 years and it's a slower bleed, that's why it's important in my chair, why having that wealth advisor at the front end to help define what we need. I think one of Mike, you said it, it's like that's the bogey as we figure out what we need to get out of the business. Um, so let's hit kind of post-sale regret a little bit. If every decision still runs through you as the owner, are you actually free? And so after the deal closes, what regrets do each of you guys hear from the owners?
Well, a lot of it is a sense of loss of identity, and really, they did not prepare emotionally for that impact. From the legal side, the most terrifying email I get is, I was contacted by the buyer and they want to talk about the earnout performance and they want money back, or there's an indemnity claim. Things that nobody either knew about, or there was a potential for a risk and that risk matured. That is a really, it could be a small deal, it could be a big deal. I've had a transaction where they came back on a $30 million deal and clawed back 13 million. That's enormous. And that is, if I had known this was going to be that big of an adjustment, I wouldn't have said. I would have kept the business and just made the money over the years. So those things do matter. Again, rep and warranty insurance has come down a lot, so it's more affordable. It's still expensive and it's got to fit the deal, but that's one way to address that concern. But a lot of the deals I'm doing, lower middle market things, they're not going to get rep and warranty insurance. So you're holding that back, you're at risk. And that's why doing during the deal, they're like, oh, indemnities is fine, no one cares. After the deal, it's a big deal. So that's one of the big regrets I see, is not paying attention enough during the transaction to pin down all those sort of loose end things that can get you.
Got it. We got about 5 minutes left. Before I do a lightning round, did anybody else have something they wanted to talk about regrets after the deal closes? And I've got a couple questions too in here that I want to address.
I would add very quickly, the one regret I see is when a seller overestimates their leverage. And they waste a lot of time and they waste a lot of resources and probably let the great buyer get away because they just thought they had more leverage than they actually had, and it wasn't really even close.
Great, thank you. And I see very rare, there's no lifestyle plan. So after like not knowing what that's gonna look like, they think they just hit the lottery after a lot of hard work. And so that's not clearly laid out again in advance. So a couple questions I want to address before our lightning round. If you have a services company, I think this was talked about a little bit on the IP side. If you have a services company as the main business and have additional IP, is it worth separating the IP into a separate entity rather for valuation purposes? I think we talked about that, but jump in, somebody.
I'll quickly jump in. I'll reiterate that selling IP as a standalone asset is exceedingly difficult. There's just not much of a market. If the IP is going into a separate entity, you're going to monetize it in the business, sure. But otherwise, I frankly wouldn't invest a whole lot of time and energy doing it.
Got it. Thank
From a
you.
legal perspective, it might make sense just to isolate it from the operating liabilities of the company, but it's really a case by case basis you need to analyze.
Got it. So another question, I wasn't in the market, but a buyer in my same industry contacted me and mentioned that he wanted to enter the market. I focus on and consider us as a strategic acquisition. We are growing 40% from last year and we're around 12% EBITDA. I feel like it's too soon to sell. He came back and offered to buy 50%. My question is, when is it too soon to sell? I had a previous business and didn't sell it, and afterwards market changed and it was a lost opportunity. When is the right moment to sell?
Wow, that is a great question.
Yeah,
And
exactly. That's
there's
the
a
meaning of
lot in it,
life.
so
Yeah.
much in it. But I think one of the things you look at is, what does your personal portfolio look like, right, outside of the business? So, is this an opportunity to take some of the wealth that you've amassed in the business, put it where it's going to be safe and secure, that that your family is taken care of, and now it gives you some freedom to operate. I think that's part of what you could look at. But the other side of it is, are you excited about this particular business going forward? Do you see for yourself that this is what you want? And you don't want anybody to touch it right now. You don't want outside influence as to how it's going to grow. Those are all factors in this decision, and it's very personal. So I think the best advice would be start putting your team together and having this conversation. Let them come and say, here are pros and cons that we see in your individual situation so that you can make a wiser decision.
Great. This one, Nate had mentioned this twice, but from a buyer's perspective, what makes acquiring an S corp, less attractive compared to other entity types? Is there a particular or potential issue that one should be aware of?
It's a lot of it's driven by the tax treatment of the S corp in a transaction. The ability, one, for owners, they're restricted to the number of owners, types of owners. Another entity can't own an S corp, but it really comes down to the recapture and the tax treatment of that S corp. S corps are great during the operating life. The acquisition side, nobody likes that tax treatment on the acquisition.
Yeah.
So the buyers are making you do an F reorg almost every time, especially if there's roll forward equity involved. That allows the seller to defer some of those taxes, where in an S corp structure you wouldn't be able to.
And so how do you protect yourself from buyers coming in to take a look and not end up buying but competing with you? Isn't that like just an NDA basically?
Well, yes, but an NDA is only as good as the paper that's written on. I mean, it doesn't prevent people
Right.
who have mad intentions from misusing it. But I think it's part of the process of identifying before you sign an NDA, but then let's do some diligence about that company before we release information. So have they actually done transactions before? Let's get about a sense of their history and who they are. Reputable, good companies have a history, have a track record. And I think that's a great way to look at. Nathan, I'm sure you've got some other ways.
Bad companies have a track record as well. So getting out there and doing diligence that way on your buyer, it's an important piece that a lot of people forget.
Yeah. And so I'm sharing, can you guys see this? Everybody's QR code. And again, Nathan is stepping in for Mitesh, although Mitesh, I think
Right. If I did a good job, send them all the business.
Yeah, exactly. So that you guys work together. Again, we're right at the top of the hour. We know time is our biggest asset. We so appreciate you guys coming out, registering. You'll get the replay. And feel free, we'll send you an email with everybody's contact, just to even get 20 minutes. You've got a lot of subject matter experts here, and we all know each other pretty well. So please feel free to reach out. Thank you all so much. And we appreciate and thank you, panelists. I love you guys.
Thank you.
Thank
Pleasure to
you.
be with you today.
Okay, everybody have a good rest of your day.